Hello, friends. If you have savings in a bank account and you are over 60, especially if you have ever received a large amount of cash from a sale or an estate and wondered whether to deposit it all at once or spread it across a few smaller transactions, this video is made for you. Because the answer to that question is not what most people think. And getting it wrong with perfectly legal money can have consequences that take months to undo. There is a specific instinct most people act on when they first hear about bank reporting rules, a decision that feels careful and responsible. And it is the single move that can turn completely legal savings into a federal investigation. By the time we reach it, you will understand exactly why it catches good people off guard. 7 things about your own account the system has never explained. Stay with me. Quick note before we get into this. This video is made for you, adults over 60, who want to understand how federal banking laws apply to their accounts around cash deposits, account ownership, and account protection. Everything I share today draws from the Bank Secrecy Act, the Federal Deposit Insurance Corporation, and the Senior Safe Act. I will name each source as we go in plain, spoken English. This is educational information, not personalized legal or financial advice. And nothing here is a promise that any specific banking behavior will or will not trigger a review of your account. If any specific legal question applies to you, please consult a licensed attorney or financial advisor before making any moves. Now let us get into what actually matters. 7 things. And the one I told you to wait for, we will reach it. I am here to tell you what the rules actually say, because in 2026, these rules are in effect. And understanding them clearly is the difference between a safe move and one that only looks safe. Before the countdown, leave a comment. Have you ever received a large cash amount and wondered whether to put it all in at once or break it into smaller deposits? Just yes or no. 7 things. Number 7, the insurance formula most people have never checked on their own accounts. Number 6, the federal law requiring your bank to file a specific report and exactly what it means. Number 5, the freeze rule that applies to anyone over 65 making a large withdrawal. Number 4, a report your bank is legally prohibited from mentioning to you. Number 3, the instinct I flagged at the top, the one that turns legal money into a federal crime. Number 2, the mistake most families make out of love. Number 1, the 10-minute banking move that fixes most of this. We start with number 7. Number 7, every account at every federally insured bank is protected by the Federal Deposit Insurance Corporation, but only up to $250,000 per depositor, per insured bank, per ownership category. If you have more than that at a single institution and that bank fails, the amount above the limit is not automatically covered. In 2023, 3 major bank failures happened in about 10 weeks. Insured depositors were protected. Anyone above the limit was rescued by a political decision, not a law. And there is no guarantee it gets repeated. If you are holding more than $250,000 at one institution, spread it across insured banks or across different ownership categories at the same bank, and every dollar returns to coverage. Write this down per depositor, per insured bank, per ownership category. That is the Federal Deposit Insurance Corporation formula. Run it on every account you hold. Number 5, under the Senior Safe Act and elder financial protection laws in effect in most states, a bank can place a temporary hold on the accounts of anyone 65 or older if it believes that person may be the target of financial exploitation. That hold can last up to 15 business days, and in some states even longer. A retiree making a large legitimate withdrawal can be pulled aside, questioned about who told them to make the transaction, and made to wait days while the bank investigates. The prevention is a phone call to the branch before you go in. Tell them the purpose. Ask them to note a trusted contact on the account. That one call turns a potential 15-day hold into a 5-minute conversation at the counter. Number 2, the most common advice given to widows, Withdrawals, and aging parents. Add a child to the account so they can help pay bills, and so the money passes easily when you are gone. When you add a child as a joint owner, that money is legally half theirs while you are still alive. If that child divorces, the balance can be pulled into the settlement. If they are sued, owe back taxes, or file for bankruptcy. A creditor can reach your account because your child legally owns part of it. Any joint owner can withdraw the entire balance at any time without asking. It can also disrupt Medicaid eligibility and override your will. In most states, a joint account passes directly to the surviving owner, regardless of what a will says. There is a better option, and I will give you the exact words to use. Number 6. Under the Bank Secrecy Act, a law on the books since 1970, every bank and credit union is required to file a currency transaction report anytime you deposit or withdraw more than $10,000 in cash in a single day. That report goes to the Financial Crimes Enforcement Network, the bureau inside the Treasury Department that handles these filings, not the IRS. Your bank files it. You do not sign anything, and you will likely never know it happened. This report is not an accusation. It is routine paperwork. If the money is legal and the source is clear, a report gets filed and nothing follows. Hold on to that fact, because what most people do the moment they hear about this report is the move I flagged at the very start. Number 1, ask your bank for a payable-on-death designation. Some institutions call it a transfer on death or beneficiary designation. You remain the sole owner of the account for your entire life. The people you name have zero access and zero ownership while you are alive. No creditor of theirs can reach it. No divorce can claim it. No lawsuit can touch it. When you pass away, the account transfers directly to the people you named, without probate, without a court, without an attorney. It is free to set up at most federally insured banks. Pause this and write down what to say. I would like to add a payable-on-death beneficiary to my account. Those exact words, for savings beyond a few months of living expenses. Treasury Direct is the government's own program for savings, bonds, and treasury bills. No broker needed. Write that down as well. Number 4. On top of the currency transaction report, there is a second type, a suspicious activity report. Under the Bank Secrecy Act, banks are required to file one on transactions of $5,000 or more when the account holder is a known suspect in connection with illegal activity, and have discretion to file on smaller amounts when something looks unusual. Under the tipping off prohibition in federal law, it is a crime for a bank employee to tell you when a suspicious activity report has been filed on your account. You could be flagged this week with no way of knowing. What triggers it is not the amount. It is a change in your normal pattern. $300 every week for 15 years. Then a request for $6,000 to pay a contractor. And the compliance software flags the deviation. The paper trail is your protection. Bring the invoice, the bill of sale, the estate letter, and the flag clears quietly. A note before the next story. What follows is an illustrative composite drawn from patterns in documented structuring-related bank reviews, not a specific individual's account. Betty is 67, a retired school teacher from rural Ohio. After her husband passed, she sold his truck and workshop tools for $14,000 in cash. Completely legal. Having heard that large cash deposits get reported to the government, she spread them across 3 weeks in amounts just under $5,000 each. That pattern, 3 descending deposits, each carefully below the reporting threshold, from an account that had never seen cash like this. Matched what structuring detection software is built to find. Within 30 days, a hold was placed on her account. She was called in to produce the bill of sale and tool receipts. 6 weeks. Cleared. No charges. The correct move was to deposit all $14,000 in one visit and let the currency transaction report be filed. The Bank Secrecy Act requires that report. It goes to the Financial Crimes Enforcement Network. With clean money and documentation, it goes nowhere. This is the instinct I flagged at the very beginning. The name for what Betty did, what many people do the moment they first hear about the $10,000 reporting rule, is structuring under federal law, Title 31 of the United States Code, Section 5324. Deliberately breaking up deposits to stay below the currency transaction report threshold is a federal felony, even when every dollar is legal. The intent to avoid the report is the offense, not the amount, not the source. The penalty is up to 5 years in federal prison and fines up to $250,000. Through civil asset forfeiture, the government can seize the entire account without filing a criminal charge. There are documented cases of retirees who lost legal savings this way, not criminals, but people being careful with money they earned, deposit the full amount in a single transaction. Document the source and let the report be filed. The bank reports, you do not commit a crime. Let me bring all 7 together. Number 7, $250,000 per depositor, per insured bank, per ownership category. Check every account against that Federal Deposit Insurance Corporation formula. Number 6, the Bank Secrecy Act requires a currency transaction report on cash over $10,000. It is routine paperwork going to the Financial Crimes Enforcement Network, not the IRS. Number 5, the Senior Safe Act allows holds of up to 15 business days. Call the branch before any large withdrawal. Number 4, a suspicious activity report can be filed at any amount without notice to you. Documentation is your protection. Number 3, structuring under Title 31, Section 5324, is a federal felony whether the money is legal or not. Deposit everything at once. Number 2, a joint account exposes your savings to a family member's creditors and can override your will. Number 1, a payable-on-death designation keeps you as sole owner and transfers directly at death. No probate. 3 things before you close this video. First, call your bank today and ask whether you have a payable-on-death beneficiary on file. If not, make the appointment. Second, use the Federal Deposit Insurance Corporation's free online estimator to confirm every dollar at every bank falls within the covered limit. Third, if a large cash deposit or withdrawal is coming in the next 30 days, write down what it is for and where the money comes from before you walk in. That documentation is the difference between a clean transaction and a 6-week review. Send this to one person you know, over 60, who is thinking about adding a family member to their bank account. Not because they did anything wrong, because they are about to make a decision that feels completely safe. And this video is the information that changes how they make it. The question I hear most from this community right now, why does a durable power of attorney sometimes fail at a bank, and what actually works instead? That answer is in the next video.